My dear students, welcome again and let us start another chapter. Our chapter about organizing production. Organizing production. Dear students, after studying this chapter, you will be able to explain the economic problem that all firms face, distinguish between technological efficiency and economic efficiency, define and explain the principal agent problem, distinguish among different types of markets, and explain why markets coordinate some economic activities and why firms coordinate others. Dear students, the innovation of the World Wide Web has paved the way for the creation of thousands of profitable business, such as Facebook, Apple, and Google. Most of the firms doesn't make the things they sell. They buy them from other firms. For example, Apple doesn't make the iPhone. Intel makes it. Memory chips and Foxconn assemble the iPhone. Why doesn't Apple, for example, make its iPhone? And how do firms decide what to make themselves and what to buy from other firms? And how do the millions of firms around the world make their business decisions? Let's start and explain all these points. The firm and its economic problem. Accounting profit. Accountants measure a firm's profit to ensure that the firm pays the correct amount of tax. And how to show it investors how their funds are being used. Profit, as we know, equals total revenue minus total cost. This is the total profits. If you want to calculate marginal profits, so marginal profits here equal marginal revenue minus marginal cost. Anyway, accountants use internal revenue service rules based on standards established by the financial account. Standards for to calculate a firm's depreciation cost. While economic accounting, economists measure a firm's profit to enable them to predict the firm's decisions. And the goal of this decision is to maximize economic profit. So, economic profit is equal to total revenue minus total cost, with total cost measured as a opportunity cost of production. A firm's opportunity cost of production is the value of best alternative use of the resources that a firm uses in production, as we studied in first year. A firm's opportunity cost of production is the sum of the cost of using resources bought in the market, owned by the firm, supplied by the firm's owner. The implicit rental rate of capital is made up of economic depreciation, foregone interest. First, economic depreciation is the change in the market value of capital over a given period. The interest foregone is the return on the funds used to accrue the capital. So the interest for GAN is the return on the funds used to acquire the capital. Resources supplied by the firm's owner. Dear students, the owner might supply both entrepreneurship and labor. The return to entrepreneurship, as you know, is called profit. You know that our production factors, four production factors: land, labor, capital, organization. The return of land is called rent. The return of labor, wage or salary. And the return of capital called interest. And the return to entrepreneurship is called profit. And the profit that an entrepreneur can expect to receive on average is called normal profit. So normal profit is the cost of entrepreneurship and is an opportunity cost of production. This is example to calculate economic accounting profit. If total revenue 400 and the cost of resources bought in market at the following all 80,000, utilities 20, wages 120,000, and computer lease 5,000, bank interest 5,000, so the total 230. Cost of resources owned by the firm, economic depreciation 25,000, and foregone interest 15, the total 40,000. Cost of resources supplied by the owner. So if you want to calculate normal profit 45,000 and foregone wages 55, both of them 100,000. So to get economic profit you have to minus opportunity cost of production, okay, to get economic profit, which here equal 30,000. The firms and its economic problem. Technology constraints. Technology, as we know at first year, is any method of producing a good or service. Technology advances over time. Using the available technology, the firm can produce more only if it hires more resources, which will increase its costs and limit the profit of additional output. A firm never possesses complete information about either the present or the future. It is considered by limited information about the quality and effort of its workforce, current and future buying plans of its customers, and the plans of its competitors. The cost of limited information limits profits. While market constraints, what a firm can sell and the price it can obtain are constrained by its customers' willingness to pay and buy the prices and marketing efforts of other firms. While technological efficiency occurs when a firm uses the least amount of inputs to produce a given quantity of outputs. Here there is example about the costs of different ways to making 10 TVs a day. The first method, or the first way, weights a wage rate about $75 per day, and capital rental rate $20 or 250 per day. So methods, we have now three methods: A, B, C. Method number A, labor 1. So here we will use one labor inputs. Capital 1000. Labor cost 75 per day. So we have one labor, so one labor will get 75 per day plus capital cost 20 or 250 per day. What is that? We have inputs, capital 1000. 1000 times 250 equal 250,000. So if you want to calculate total cost here 75 plus 250,000 equal 250,000 and 75. Method number B, another combination between labor and capital to get 10 TVs a day. Labor 10 labor, not 1. Capital 10 capital, not 1000. So the result, total cost here equal 750 plus 2,500 equal 3,020, 250. Method number C. Here we will use 1,000 labor, 1,000 labor, and just 1 unit of capital. Cost of labor here 75,000 plus capital cost here 250. So the total cost equal 75 2,050. The least cost here, method number B, 3,250. The other way number B, wage rate here 150 per day, capital rental rate $1 per day. Now we have three methods. Method number A, we will use one labor and 1,000 capital unit. Labor cost here 150 per day, and capital cost just $1 per day. So the total cost here 150 plus 1,000 equal 1,150. Method number B, 10 units of labor, 10 units of capital, so the total cost 1,510. Method number C, 1,000 labor, so the labor cost 1,500 plus capital cost 1. Notice we will use just 1 unit of capital. The total equal 150 and 1. So the least cost here, method number A, 1,000 and 150, and so on. By the same way number C, rate $1 per day, capital rental 1,000 per day. Also we have here three methods. The least cost, method number C, 2,000. Okay. Yeah. So the firm and its economic problem decision to maximize profits A firm must make 5 basic decisions: what to produce and in what quantities, how to produce, how to organize and compensate its managers and workers, how to market and price its products, and what to produce itself and what to buy from other firms. And the firm's profit is limited by 3 features of the environment: technology constraints, information constraints, market constraints. Technology is any method of producing a good or service. Technology advances over time. Using the available technology, the firm can produce more only if it hires more resources, which will increase its costs and limit the profit of additional output. A firm never possesses complete information about their present or future, as we said. It constrains by limited information about the quality and effort of its workforce, current and future buying plans, and its customers, and the plans of its competitors. And the cost of coping with limited information limits profit. A firm organizes production by combining and coordinating productive resources using a mixture of 2 systems: command system, incentive system. Command system uses a command system uses a managerial hierarchy. Commands pass downward through the hierarchy, and information feedback passes upward. These systems are relatively rigid and can have many layers of specialized management. While intensive system is a method of organizing production that uses a market-like mechanisms to induce workers to perform in ways that maximize the firm's profit. While mixing the systems, most firms uses a mix of command and intensive system to maximize the profits. They use commands when it's easy to monitor performance or when a small deviation from the ideal performance is very costly. They use intensive whenever monitoring performance is impossible or too costly to be worth doing. The principal agent problem. Dear students, the principal agent problem is the problem of devising compensation rules that induce an agent to act in the best interests of the principal. For example, the stockholders of a firm are the principals and the managers of the firm are their agents. Coming with the principal agent problem. 3 ways of coping with the principal agent problems are ownership, incentive pay, long-term contracts. Types of business organization. Dear students, there are 3 types of business organization: proprietorship, partnership, corporation. Proprietorship is a firm with a single owner who has unlimited liability or legal responsibility for all debts incurred by the firm, up to an amount equal to the entire wealth of the owner. While partnership is a firm with 2 or more owners who have who have unlimited liability. And the third type, corporation, is owned by one or more stockholders with a limited liability, which means the owners have legal liability only for the initial value of their investment. And each type of these business organizations have advantages and disadvantages. Proprietorship are easy to set up. Managerial decision making is simple. Profits are taxed only once as owner's income, but has disadvantage. But bad decisions made by the manager are not subject to review, and the owner's entire wealth is at stake. The firm died with the owner. This is the disadvantage of proprietorship. Also, the cost of capital and labor can be high. While partnership are easy to set up also, employee diversified decision-making processes can serve the withdrawals of a partner. Profits are taxed only once, but achieving consensus about managerial decision is difficult, and owner's entire wealth is at risk. Also, capital is expensive, and withdrawal may create shortage. The last one, corporation, limited liability for its owners, large scale and low cost capital that is readily available, plus professional management. Lower costs from long-term labor contracts. But there is a disadvantage. It's summarized in complex management structure can make decisions slow and expensive. Also, profits tax twice as corporate profit and shareholder income. Economists identify four market types. It is another important point. We have perfect competition market, monopolistic competition market, oligopoly market, monopoly market. So we have four types or four kinds of market: perfect competition, monopolistic competition, oligopoly, monopoly market. First, perfect competition is a market structure with, so the following is conditions of perfect competition: many firms and many buyers, all firms sell an identical product, no restriction on entry of new firms to the industry, both firms and buyers are all well informed about the prices and products of all firms in the industry. Examples include world markets in rice, for example, wheat, corn, and other grain crops.